Well, equities slipped last week with the S&P 500 notching back-to-back weekly declines for the first time since October of 2023, after hotter than expected CPI and PPI figures from the United States saw rates ratchet higher, led by the front end of the curve, in turn sending the dollar to its best week since January. A huge week awaits the financial markets this week. We've already had the Bank of Japan ending their negative interest rate program with the first rate hike since all the way back in 2007, and now market participants are starting to look ahead to what else the week holds, including decisions from the Fed, the BOE, the Swiss National Bank and the Norges Bank, plus a jam-packed data docket as well. There really is no shortage of topics for us to discuss on the trade-off this week. So without any further ado, let's get into the show. Well, it really is a monster week for the financial markets this week. The week that has it all, some may say. Let's, as always, bring in my co-host, Ryan Littlestone from Forex Flow Live and Forex Analytics. And Ryan, I think we should probably preface this show by saying that we've both been up since about 2:30, 3 o'clock this morning. So anything could happen on the trade-off this morning.
Yeah, good morning, Michael. I'm still sitting in my pajamas and, I'm on my third small cup of coffee today, so it's going to be a long day. It's going to be a long week as well.
It really is. There is plenty going on, and we've already had some fireworks with the Bank of Japan taking some further steps towards normalising policy this morning, and I'm sure the rest of the week is going to hold plenty of fireworks as well. And I certainly can't wait to swap out that coffee you're holding there for a beer come Friday afternoon when we relax and put our feet up at the end of it. But that is still some way off, and we've got plenty to get through before then, so let's crack on with Topical Thunder. So we're going to shake up the order of the show a little bit this week. I'm giving the reins to Ryan, who is going to crack on with the first topic and digest what we heard from our good friends over in Tokyo in the very early hours of this morning over at the Bank of Japan.
Yeah, very much so. And there we have it. Negative interest rates have gone. YCC has gone. ETF buying has gone as well. All hawkish, right? As we might be led to believe. Apparently not, though, according to markets. This generational ending of negative rates come with a ton of not so hawkish conditions. The interest rate will be in a range, 0% to 0.1%, where it was previously sub 0.1%. They will be continuing to buy JGBs at around the same amounts as they were before. So as we expected, it's a hike, but not a hawkish one. What was missing in the statement was any hint of future rate moves or any future policy changes in any form. That was a little bit of a taken dovishly by the market initially. Then we've since had the press conference from Ueda, and he started on the dovish side, talking about considering various tools when easing is needed, and there's still some distance for price expectations to be at 2%. Then he moved into what could be considered a bit of a hawkish slant by talking about the conditions for future hikes, by saying we are in a phase where we can probably slowly proceed with possible rate hikes. But you'll know the probablys and possiblys, and there was a lot of that in there. Now, all in all, we've been mapping out this road, and it's pretty much gone exactly as expected. They've ended easy policy, but taking things very slow and very steady. It's been expected, it's been telegraphed, particularly the last couple of weeks, and that's really muted the market's reaction since. So from here, we go back to data watching, but I expect we'll retain some of the recent volatility because the data now needs to play ball with this policy turn, and the Bank of Japan are still walking a very fine line at the moment. So if we tip back on the inflation numbers, then the market's going to think, well, we're not going to be seeing future rate hikes coming in. But then if we get stronger numbers, the market's going to get expectant about whether we're going to see future hikes. So, as I say, walking a very fine line. We're here. We finally got there. Months and years of waiting and talking about it, particularly on this show, and we've done it. So, what's next, Michael?
Oh, yeah, give me the easy questions, mate. And I haven't had a gallon of coffee to wake me up this morning. I've only had 9 espresso shots. Right, the Bank of Japan, as you say, I think slowly but surely making their way down this road towards policy normalization, a road that you have guided us down brilliantly over the last year and a half, as you rightly alluded to. I guess the way I was sort of thinking about the BOJ before their decision, as straight as one can think at 2:30 in the morning, was, do they go for this sort of one and done? We're normalizing, we're getting rid of negative rates, we're getting rid of yield curve control, we're then going to just sort of sit tight and see what happens? Or do they go for a more prolonged tightening or normalization cycle, whatever you want to call it? I guess from UAIDA's press conference, they've kind of gone for an approach somewhere between the two. They've kept that optionality to do more in terms of hikes if they do see inflation continuing to move higher or sustainably achieving the 2% price target. But at the same time, they're not really pre-committing to anything. So I think whereas sort of this time last year or the middle of last year, we were saying, if the BOJ hike, they could end up as a sort of hawkish outlier among G10 central banks. I'm not entirely sure that's going to be the case this time around. It's a very patient and data-dependent stance that we've now got from the BOJ. And I think actually, the normalization, tinning NERP, tinning yield curve control, kind of passed without event, which is no surprise when they gave their friendly journos at the Nikkei a bit of a wink 12 hours before they dropped their decision. And I think we now go back to trading the yen based on what we've always traded the yen, which is treasury yields and risk appetite.
Yeah, probably very much so. And we've got to remember, they're still doing their JGB buy, and they've got to do that because they own such a big part of the market already. They can't just switch that off. But when you come down to the super nuts of it, all they've done is end easing in terms of cancelling YCC, cancelling negative rates, stopping ETF buying, which they effectively did last year. So we're not even in a tightening stage yet. We're at an end of easing stage. So we still may have the tightening stage to come, but as we said, that's going to be guided by the data. So it's important to take things in context. And this is the Bank of Japan, and they move in decade-long policy cycles. So it's not like the Fed or the ECB where they might switch every 5 minutes. Yeah, it's going to be a long path ahead still.
Yeah, absolutely. And let's hope it is a decade before we have to set a 2 o'clock alarm call once again. In any case, you mentioned the Fed, so let's move on to the FOMC, because now the Bank of Japan is well and truly out of the way. The limelight does turn to the FOMC, who, of course, start their 2-day policy meeting today, with the announcement set to come on Wednesday evening here in London. Just a bit of housekeeping for folk in London. The decision will be at 6 o'clock, not the usual 7 o'clock, because obviously the London-New York time difference is 4 hours at the moment until we put our clocks forward here in the UK in a couple of weeks' time. So do not get caught out by the Fed being an hour earlier than normal. What are we expecting? Well, not a lot, in short. The target range for the Fed funds rate should remain at 5.25% to 5.5%. That is what the market is fully pricing in. That is what pretty much everyone on the sell side is expecting as well. And you would expect that is once more going to be a unanimous vote among FOMC members as well. Other areas of the decision, are they going to be a little bit more interesting? Potentially, but I'm not too sure, to be quite honest with you. I think the policy statement is going to be pretty much a carbon copy of that that was delivered after the January meeting, emphasising the data-dependent stance, with the Fed continuing to seek what they term greater confidence that inflation is moving back towards the 2% target, although I think they may just take out the line about job gains moderating, given that the 3-month average of payrolls growth is at its highest level since last June. It wouldn't be quite right to describe the labour market in those terms. We do, though, as it is one of the quarterly forecast meetings, we do get from the Fed their latest summary of economic projections. Is that going to be any more interesting? I think you probably know the answer at this point. Not really. The economy is pretty much evolving broadly in line with the projections that the Fed outlined at their December meeting. You may see a modest upward revision to the PCE and the core PCE forecasts, given the hotter than expected CPI and PPI numbers that we got recently. But PCE is calculated very differently from both of those metrics. So there's not a sort of straight read across. I don't think the revisions are going to be too drastic. We're talking sort of 0.1% here or there. You then need to look at the dot plot. And I think the Fed's dot plot is going to be the main focus of the March FOMC meeting. At the moment, of course, the 2024 median dot points to 75 basis points worth of cuts, effectively 3 rate reductions being delivered this year. The likelihood is that the new dot plot is pretty much unchanged and continues to point to that as a median expectation, but perhaps with a tighter dispersion as confidence grows in the Fed's forecasts. But it is important to recognize that it will only take 2 policymakers moving their dot higher for that median to shift from 75 basis points of cuts to 50 basis points of cuts this year, with one of those cuts coming out of the market. And that obviously poses a pretty chunky downside risk to treasuries, particularly at the front end, and an upside risk to the dollar if it were to occur. And then, of course, Fed Chair Powell's press conference. Well, we heard from Powell on Capitol Hill just 2 weeks ago. I think he's really going to just repeat those remarks, basically reiterating that they are waiting for more data before they remove some of the restriction that they've brought in to the economy over the last couple of years or so. So all in all, I'm not sure about your thoughts, Ryan, but for me, although it is a Fed meeting and it is naturally important and we all get excited about it, I think this is more going to be a placeholder as the Fed just remain in this wait and see mode. They want more data. They haven't got the data to cut yet, and they're going to just say that they are still waiting to see the data that proves inflation is on the right path before they deliver that first rate reduction, which I reckon is still going to come in June.
Yeah, well, I hope, and as do our viewers, that your negativity regarding the action is around this meeting is a kiss of death, and we get plenty of volatility. But yeah, I feel you may be right. But as you said, there are a couple of items that we need to focus on. Yeah, I think the message is going to continue to be, we're not there yet, job's not done, everything like that. I'm split, and then this is coming out in some of my play of the day later on, in my view about how he might present things here. I think there might be a little bit of a nod to whether the consumer might just be on the wobble a bit. But I think, overall, it should be a nothing meeting. I think the dots are going to be extremely important. We've already had, I think it was Mester a week or so ago saying that she's potentially going to move her longer run dots up. So we always get 3 years of dots, so 24, 25, 26, and then we get the longer run dots. And I think if those move up around the far end, 2025, the longer term dots, that will effectively increase that higher for longer message, because it means that the neutral rate may be coming higher. It may be a little indication of where they see rates settling in the longer term. So I think that's where we may get a bit of a volatility coming in, maybe more so than what happens to the 2024 dots. I don't think they're going to change. But as you say, it doesn't take much, 1 or 2 dots to shift around and the picture changes. So, yeah, steady as she goes, I think. But as we've been talking about on the show, I'm going to be watching for any little worrying comments or comments from Powell over just worries about the economy, because we have seen that consumer just soften a little bit.
Yes, actually, I'm very glad you raised that point about the longer run Fed funds rate. This is something I was discussing with your mate, Blake Morrow, and Dick Matthews last night, actually. I think that for me, and I know I've harped on about this for ages and ages, and probably everyone's bored of this now, where I'm talking about how the policy backdrop is going to become increasingly easier and increasingly supportive as the year goes on, and that should support risk assets. I think the big risk to that is if markets move from what they're pricing at the moment, which is, let's be honest, if they cut in June, July, September, don't care, they're going to cut. But the market is pricing that cut is then followed by 8, 9, 10 more, which gets us back to neutral, and we have a neutral policy setting for a few years. If you suddenly move to an environment where the market, either by virtue of the dots shifting, the longer run dots shifting, or because inflation remains relatively sticky and 2% becomes a floor rather than a ceiling as it was pre-COVID, if you then move to a scenario where actually markets end up pricing a much shorter and a much shallower easing cycle, that is then when you really start to talk about headwinds coming back in for risk assets. So I think that's definitely it's a bit of a difficult theme perhaps to get your head around, but I think it's definitely something that is important to keep on the radar. Although I would caveat that by saying investor is retiring in June. So she has a little bit more license than other Fed members to go slightly off-piste with her remarks at the moment.
Yeah, very much so. And I think we got a couple of. They've got one newbie as well coming up as well. Can't remember the name.
Yeah, we do, but I've forgotten his name as well. So let's move on to UK inflation before we both embarrass ourselves.
Quickly, change the slide.
Yeah, move on.
Right, so we will move on. We'll move on to some UK inflation because potentially big moment for the pound this week. You know, twinned with all these central bank meetings. We've got some big data, and none is bigger for the Bank of England this week than the latest inflation numbers due on Wednesday, and that comes a day before the MPC announcement. Now, my consistent, and I know Michael would say this probably too, that my persistent view has been that the Bank of England was always going to go higher with and longer with rates than other central banks, and this is a potential crunch point for trading the pound. With the ECB looking to cut in June and the BOE seemingly nowhere near to tipping the nod to a cut time, this inflation data is going to be a big mover for the pound, or potentially a big mover for the pound. Now, headline CPI is expected to drop quite significantly to 3.5% from 4% previously. Core dropping by the same amount to 4.6% from 5.1% in January. Now, the reaction in the pound should be pretty simple. If the numbers are above expectations and maybe even closer to last month, the pound is going to bounce as the market will instantly price a higher for longer MPC. If the numbers come in below expectations, the pound will obviously fall, as then we will be expecting to hear some language on cut timing. So really, they're not going to do anything. The votes will be important as well. Always have to pay attention to the votes. But this inflation data is maybe going to get the market setting its way as for expectations for this meeting. So whatever the expectations for the Bank of England are now, you need to see that inflation data to just make that final choice.
Yes, very much so. I fully agree with you on that one. I think the UK inflation picture is interesting because we all know there's going to be a big fall in headline inflation as we move into the second quarter of the year in particular. But we also all know that is going to be driven almost entirely by energy prices because of the way that we have the energy price cap here in the UK and the way that's going to come down substantially in April. So I think the BOE are still going to pay very, very close attention to the services data, and services CPI has been running north of 6% here in the UK for getting on for 2 years at this point, which is clearly showing signs of persistence, clearly showing signs of stickiness. And actually, I like the way that, and I'm loath to do this on the show, but I'm going to do it anyway. I really like the way Morgan Stanley actually framed this week for the UK in saying that Wednesday is more important than Thursday. And I think they're absolutely right, because I'm going to get onto the BOE in a second, but are they going to move the needle significantly? No, absolutely not. Is the inflation data, or does the inflation data have the potential to move the needle significantly? Yes, it absolutely does. And of course, just a note on the logistics, as always, the MPC will vote on their policy action on the Wednesday evening, with the decision then due on the Thursday lunchtime. So they will have full sight and a breakdown of all that inflation data by the time they come to deciding whatever they're going to do when we get that decision on Thursday lunchtime.
Yeah, absolutely. So, I mean, I'm surprised they managed to keep it from leaking, given their record previously. But, we won't talk anything about that.
No, but it's all right, though, because, Ben Bernanke's coming in to solve every problem the BOE have ever had, isn't he?
Yeah, I'll be getting something on that as well. I can't remember. I think
April, apparently, is what we're going to get that. Can't wait.
Keep the can on that one. We'll find out what Ben Bernanke's got to say about things. I can't wait for that. I hope he slaughters them. But anyway, moving on from that. But I'm strangely finding myself in agreement with Morgan Stanley as well, which doesn't happen often. I'm probably been up too early. There's something like that this morning, or I need another coffee.
I think the lack of sleep is getting to us both. I was going to say, just lastly on that, we'll get on to the BOE in a second, but if Ben Bernanke is the answer, what the hell is the question that you're asking? That's what I would love to know. In any case, let's get on to the best of the rest, because it is a ridiculously busy week this week for the financial markets. It's not just the BOJ, it's not just the Fed. There is a whole host of other stuff going on. I may as well start with the Bank of England, given that we were just talking about it. As Ryan said, I think the key thing to watch from the BOE is going to be their vote split. We're expecting bank rate to remain unchanged at 5.25%. I think the BOE are going to remain data dependent in determining how long rates need to remain at their current level, naturally focusing on the services inflation figures that we just mentioned, but also on incoming earnings data, which does show signs of cooling. The vote split, the key thing to watch. Last time out, it was 6-1. That's unchanged, hike, cut. Haskell and Mann voted for a hike last time out. I think they'll probably do so again. There hasn't really been anything in the data to suggest that they would change that view, although there is obviously the dovish risk that they do move back in line with the core of the MPC. I think Dingra almost certain to vote for an unchanged decision. For a rate cut. This is all falling apart at this point. And I think the risks overall over the MPC meeting do tilt in a more dovish direction, given the possibility of that vote split moving back towards more unanimity on the idea of maintaining bank rate at its current level. I'm going to get through the rest of this list relatively quickly before it all goes to pot. Thursday is a very, very big day of central bank meetings. We also hear from the Swiss National Bank. The market pricing a 1 in 3 chance of a 25 basis point cut from the SNB. I think that's probably a little bit underdone, given that inflation is right at the bottom of their target range at the moment. Naturally, the valuation of the Swiss franc will remain the primary focus of policymakers over in Switzerland, as Thomas Jordan prepares to leave the central bank in September. We also hear from the Norges Bank, again, not expecting any changes to rates, but the market only prices about 15 basis points worth of cuts in Norway by August. So it'd be interesting to see whether that pricing shifts significantly after what the Norges Bank have to say. And then besides that, there's plenty else going on as well. We've got the loan prime rates due out of China, not expecting any shift in either the 1 or the 5-year rate. But if the PBOC did want to deliver, or were told that they needed to deliver a little bit more stimulus, then that is another opportunity for them to do so. And then on the data front, we've got a whole host of flash PMI figures out of pretty much every major developed economy that you can think of. It will be nice to see if the UK can remain at the front of the pack in terms of the composite PMI measures, but I think naturally the market and certainly policymakers will focus more on price pressures and indicators of inflation and whether that is continuing to be squeezed out of the economy in those PMI figures. And then, as if that wasn't enough, we've also got the latest UK retail sales data. That's not going to impact the BOE as the data's out on Friday, the BOE Thursday. And we've also got the latest ZEW and IFO surveys out of Germany as well, which are leading indicators for what remains the sick man of Europe, even if it is the largest economy in Europe. Somehow managed to get through all of that. And it's going to be a pretty busy week, isn't it?
Yeah, I don't think we've got enough central banks this week. I think it was 8, 9, and you've missed out Banxico. You know, this week Michael's insulting the Mexicans because missing out Banxico. You know, added to the list with the New Zealands, the Kiwis over there, and the Chinese. You know, building a long list of complaints, mate. But yeah, I'll let you off this week as it is a busy week. This is one of those weeks I'm excited about and dreading at the same time. Going to be absolutely ruined come Friday evening. I can tell you that for now. So yeah, that Stein jug will be filled with beer later on. We've got to take each moment as it comes. It's a real difficult one to trade, like it has been for the last couple of weeks. When you get these big trading moments, these big risk event moments, you've got to be careful with your trading. You know, you can't jump into a position on the SNB that's going to get flipped out maybe on the Fed and vice versa. So again, it's a week if you're trading it. You need to know where we are at the end of the week. If we've broken ranges, if we're in new ground with FX pairs and other assets, if something has changed the narrative, the range plan that we've been in for several weeks, several months, if that's changed, then that's something you need to look at. Otherwise, If we're still in the same old ranges, then for trading, you've just got to continue to trust those ranges.
Yeah, absolutely. Fully agree with that one. I think it's a week where there are so many moving parts that capital preservation, as always, and risk management become the number one priorities. Be careful not to just get swept away in it all. There are, take, as you say, each event as it comes. We've had the BOJ, we move through the BOJ, and now we move into the Fed. And then when the Fed is out of the way, we move into the busy data slate that we've got coming up on Thursday. Don't sort of try and jump the gun or get ahead of the game, because that's when things do start to really potentially get out of control and get very, very difficult to manage. But there is a lot going on. So let's have a look at some charts which might help us navigate our way through that. Right, we'll do this in the normal order. It's nice to shake things up every once in a while, but back to normality with me talking about the US equity market and me being bullish on the US equity market, which I'm sure will not surprise anyone. The reason I bring this up, though, is because, as I said in the introduction to the show, both the S&P and the Nasdaq notched their first back-to-back weekly losses since October of 2023 last week. But I think the path of least resistance continues to point to the upside, and actually trade on Monday, yesterday, proved that relatively well, I think, with both the indices notching pretty solid gains, albeit closing off the highs. But those gains came amid a lack of really any major news or data flow, which just points to me that the buyers are still in control of things, and that the path of least resistance, as I said, continues to lead us to the upside. Obviously, there is plenty of risk going on this week. The Fed present the biggest risk out there. But I think looking in the big picture, as we just discussed, whatever the Fed do this week, I don't think it's going to be a major game changer for risk appetite over the medium term. I think the broader and more longer run policy path is going to remain unchanged, as we were discussing earlier. Rates are set to come down as we move through this year. Quantitative tightening should come to an end, and the Fed put, the flexible Fed put, remains alive and well. So I remain bullish. I think any dips are likely to be relatively limited and remain buying opportunities in my mind. And if we do get any sort of knee-jerk move lower, perhaps as a result of Powell's presser or even a hawkish revision to the dots, then that is an opportunity that I would be looking to reload longs in the US equity space.
Yeah, I can agree with that, and I'm definitely not stealing your thoughts on this one, like you outrageously.
We're not going there again.
Yeah, I'm still chomping on that one. Yeah, I mean, we've just spoken about, looking at where markets are at the end of the week if they've broken new ranges. Well, here we've got stocks and the S&P that continues to climb higher. Although it has put in a bit of a high, we've marked a more substantial high than we have since around the 50 area, where we had a bit of time between those highs. So there is maybe some signals that we might be looking to run out a bit of steam. But as you say, the dips are very shallow. I think it was down to close to 5,100, just below 5,100 last week, and then we've bounced all the way back up again. So there's no signs of this trend stopping until we start breaking some of those support points. So yeah, I've not got much to add to that. I'm still long, and I'm just happy to sit back and let it go where it wants to go.
Well, in that case, why don't we move on to talk about the yen once more?
Yeah, might as well. We're going to talk about what's next. We've had the Bank of Japan. We've had some moves in the yen, obviously. So we're going to have a quick look, see what's gone on and what might be coming up next. Now, so far, the move in dollar yen seems to be a typical buy rumor, sell fact move, which we've been saying for the last few weeks on the show is exactly what we've been building towards. Now, we were knocking around the 149.20-30 area into the announcement today, and we only managed a quick move to 149 on the actual announcement, which actually surprised me because I thought we might get a bit of a decent confirmation move. It's okay having sources and rumours and story, but the market tends to like that confirmation. But 20, 25 pips, that's all we got before jumping higher. The lack of forward guidance on rates in the statement saw us rally right up to 150.48. That took us into Ueda, and then his comments on the rate path saw, I might call it a bit of profit taking coming in. And as of the time of this chart, we've pulled back to near 150. Now, it's probably going to take a session or two before the market really decides what it wants to do here. And we still need to get a bit of a response from the news from, some of the big Japanese whales and other investors about what they want to do with things like bonds and negative rates. So watching for flows will be really important now. We're going to see investors coming into Japan more so. We've had that big rally in the Nikkei. Is that going to continue, or have we seen a potential top coming in there? So that's going to be important now, the flows that we see. And we're also going to swing right back into trading the FOMC as well. So the Fed influence will be a factor also. Now, to be honest, I couldn't honestly pick a side right now on which way the next 100 pips is going to be. So all I'm going to do is
get off the fence. Come on.
Well, I'd like to know which way I'd like it to go, because I did pick up a long after the announcement, so I'd like it to go up. But I tend to look at the bigger ranges, look at the levels to see what the price needs to do if we're going to make a real move. So we all know that 152 is the big level above. Below last week, we had a move to 146.50 around that 147 area. A couple of dips under it held, so that's the level below for me. Then between there, we got a bit of a tighter range, 150, 88, 90. We haven't been close to that yet, up to that 151 level. And then down 148, 85, 149, where we saw that support this morning after the announcement. So that's a little intra range, as you can see there on the chart, that blue one. For now, those will be my guide for this week. If we're outside that wider range come the Friday close, we'll likely know that the market has made a bit of a decision on either or both of those central banks, the Fed and the BOJ. If we're still within those ranges, that will tell me the market is happy with where it's pricing and will likely consolidate for a while. So more range trading to come. And one thing I have noticed this morning is we've seen a real big drop in volatility. For example, the dollar yen 1 month at the money option vols has been trading, 7.5%, 8% recently over all the stories and sources pieces. This morning after the meeting, we're down at 7.03%. So we've had a big drop off in volatility now that the market knows what's going on. So that's going to be a consideration as well. Watch for the range. If we're breaking it, then we've got something. If not, then we're probably going to consolidate.
Indeed. That was incredibly comprehensive, mate. There's really not anything that I can add to that at all. So let's move on to the dollar, revisiting last week's play of the day with this one. It's not just dips in the equity market that are there to be bought, but in my mind, dips in the dollar that are there to be bought as well. And we saw quite a nice rebound off the 102.50 lows in the dollar index last week, using that as a bit of a lazy proxy for the dollar more broadly. Last week was actually the dollar index's best week since January. And personally, I think there's still quite a lot to like about the greenback, to be honest with you, both from a yield perspective and also from a growth perspective. There's relatively little that beats the dollar on either of those fronts, particularly in the G10 universe at the moment. And I think the other thing that is now starting to come onto the radar a little bit more is you look at other G10 central banks, you look at the ECB. They're pretty much nailed on to cut in June at this point. You look at the Bank of England, increasingly the risks are pointing towards them cutting at the very start of the summer as well. And then you think about the Fed, and actually the risk is starting to tilt towards cuts being delayed and postponed over in Washington, D.C. The market yesterday actually moving to price less than an even chance of a 25 basis point cut in June for the first time this cycle. And I think with that balance of risks tilting in a little bit more of a hawkish direction over the Fed on Wednesday evening, that could give the dollar index its next leg higher. And if we get a closing break north of this bunch of moving averages, the 100 and the 200-day moving averages, which both come in around 103.60, 103.70, if we can close above that level, that helps to reinforce that bull case from a technical perspective as well. So I remain bullish. I'd look to add to any longs on a break above that level. And I think the dip remains there to be bought in the dollar for now. And that US easy for me to say, US exceptionalism or US outperformance, because that's much easier, theme is not dead yet, even though my ability to speak seems to be. And so does Ryan's, because he's somehow managed to mute himself. I'm not entirely sure what he's done.
See, yeah, it's all going wrong today. I've managed to nudge my mute button on my microphone, but that's what getting up at 2 o'clock in the morning does for you. But I make you right in the levels. I'm not a big fan of the Dixie, as you know. 103.80, I know, is a level that a lot of people have been looking at, and we broke below and held below that. We have seen a bit of a pickup in the dollar. You couldn't get a dollar buy the last couple of weeks, but the latter part of last week, we just saw the dollar picking up a bit of steam. I think that's obviously a bit of FOMC influence as we move into that orbit. I'm in two minds, and that'll be reflected when we get to the plays of the day as to how long or whether this dollar strength can be sustained, and whether the market is actually correct about the Fed and the message it may bring. So I won't get into that too much, but I'm cautious about this dollar move at the moment, and whether it can last.
Well, there we go. We'll find out more in about 5 minutes' time. In the meantime, why don't we move on to the euro?
Yep, going to look at euro sterling. Again, just tying it up with the data we got this week and the Bank of England, and this is potentially another big moment for that 85 level. Now, I have several trading rules for big historical levels like this. Firstly, big levels are worth trading. You can see from the chart there how many times we've held it over the course of last year and into this year. Two, the more often a big level gets tested in quick succession, the greater the chance of a break. So the more times we knock on the door, then the likelihood is that door opens and we suddenly get a breakthrough. And thirdly, the longer that level holds, the more volatile a move can be if that level does finally break. And that's because everybody who's buying off that level, continually buying off that level, the stops grow below it. So they get bigger and bigger on each test, so that if you do get a break, it can tend to move quite hard and fast. And so here we find ourselves in euro sterling trading some 50 pips above the 85 level. As I say, been in play lots of times, it goes back some 15 years if you want to look at the chart that far back. And since July, we've had many tests and holds. We've tried to break it on a couple of occasions, but it's always held very strongly. What's been different so far this year in particular is that we failed to bounce that far from the level. And now with some big UK and Eurozone data and the BOE this week, we might have another big decision point to make. Now, I've been playing longs off this level since late last year, since the summer even. And if I follow my own rules, this lack of bounce to the 50s, 85, 70s has me concerned that we might be setting up for a break. And if that happens, it might have some legs. So to counter that, I've got my stops on my longs just below 84.80, but now I'm planning to make my stops reverse to shorts should we break. So even if you're not in a trade at a big level or trading this one at all, entry stops are a good way of catching a break move should they happen, as it allows you to get in when the break happens rather than trying to front run a break that may not occur. So I'm getting a bit twitchy about this 85 level, and I'm going to start positioning myself accordingly.
It's an interesting one. I'm kind of in two minds as well. I mean, you look at the fundamentals on either side of the channel, I suppose, and the UK would come out on top on pretty much every single measure you choose, particularly on a policy differential basis. But then you look at where yield spreads are, and actually the UK 2-year spread between the UK and Germany would point to euro sterling being sort of 87.5 rather than 85, which when you add that to the way that the pair keeps bouncing off this level, that might suggest being long. So yeah, I'm very much, well, like you were in terms of dollar yen, I'm sat on the fence with this one. I might be tempted to wait for the BOE to do whatever they're going to do on Thursday, and also get the inflation figures out of the way, and then take a look at this in what would hopefully be a bit of a cleaner environment to get a read on where we may go next. But for once, and it's not often you say this, euro sterling actually looks quite interesting.
Yeah, it does. And it has its little snoozy moments where it takes 8 days to go anywhere. But I love these big levels, and I love these moments that we get that can be make or break for them.
Yes, indeed. Right, let's move on to our plays of the day. Right, I'm going to talk about Euro Swissy this week, keeping it relatively short and sweet. We mentioned the Swiss National Bank earlier on, and I continue to be bearish into the SNB. We mentioned earlier that the market price is just a 1 in 3 chance of a rate cut from Thomas Jordan & Co. And I think that's probably a little bit done. You've got to remember that the Swiss National Bank have, well, I'm sure everyone remembers this, the potential to surprise markets with their policy action, to say the least. And I think the other thing to bear in mind is that the SNB, they only meet quarterly rather than 8 times a year, as most of their G10 peers do. So they may look to try and get ahead of the ECB in terms of kicking off their easing cycle at this meeting. But even if they don't hike, even if they don't cut, even if they keep rates unchanged, I think it's likely that their dovish pivot will continue. Inflation remains pretty much rooted to the bottom of their target range, and the SNB are very, very focused on ensuring that there is no further real appreciation of the Swiss franc, given the further disinflationary implications that would have. And now that we've broken north of the 96 figure, the uptrend in Euro Swissy remains intact. So I remain long here, and I think the 97 figure remains within sight, either during or perhaps shortly after the SNB. Ryan, you're in the fixed income space this week.
I certainly am, and I'm looking to perhaps fade some hawkish Fed expectations in this one. As I said, this is a trade that sort of somewhat goes against my own view of the Fed, in that I expect plenty of jobs not done rhetoric and a potential push or further push for the higher for longer narrative as well. But I think the market is maybe going a bit too far in its non-dovish pricing, as I still feel that the US consumer might just be wavering a little bit. So to that end, the uplift in yields recently has me thinking about a bit of a fade play. US 10s are on a bit of a level here, up at 435, 440, which is around 97 in price terms. So I'm looking for a buy closer to the FOMC in case Powell does flag some Fed worries over the consumer and economy, potentially then confirming a date in mind for cuts. The risk for this trade is obviously something more bullish from Powell about the economy, and thus confirming the market's non-dovish slant that it has at the moment. So if this trade pans out on a yield basis, I'll be looking for a move back below that 420 level, which has been quite important. And then we'll see how it goes from there.
Good stuff. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Glow Live and Forex Analytics for joining us. Thank you also to our producer, Kyriakos, for bringing this together as brilliantly as he always does. And apologies once again for our slightly sleep-deprived state during this week's episode of The Trade-Off. Despite that, we are going to both go for a nap after this, I think. Despite that, I hope you've enjoyed the show and there's been some value in there. It is a very, very busy week ahead for the financial markets, and hopefully we're helping you to navigate you through that. If you have enjoyed the show, drop a like on the video, leave a comment as well. Let us know how you're trading the markets and your thoughts on some of the key risk events that we've got coming up. And of course, we'll be back with the trade-off this time next week to digest and take stock of everything that has taken place. In the meantime, thanks very much for watching, and goodbye for now.